Well, Justin, welcome to the podcast. It's great to have you on. Glad to have you joining me for what I think is going to be a great conversation today.
Thanks for having me on, Victor. I'm looking forward to it.
Well, I think what we have in store for our listeners is going to be pretty exciting. We're talking about private markets and alternative investments, kind of a budding area in our field and something that I know that you work with a lot with your clients. And so that's why I wanted to have you on today so we could kind of talk through this together and give our listeners, some takeaways as far as what they should be thinking about when it comes to those private investments.
Yeah, these are things that we talk about all the time in the office, but I think it's important for our listeners, clients, and prospective clients to really get an insight into, what the details that we're looking at whenever we're constructing a portfolio. And, for me, it's always looking at it through the lens of an advisor. And from an advisor's perspective, I'm always trying to maintain the high quality return profile while trying to reduce overall volatility. And one great way to do that is through introducing private market alternatives. When it comes to investing, one of the first keys you learn when you start investing is diversification. Most people think about diversification as buying multiple companies, multiple stocks within your investment portfolio, which is correct. But adding a second layer of diversification is through asset allocation. And some examples of additional asset classes would be stocks, bonds, real estate, private credit, private equity, and even cash. And so the reason that's important to have multiple asset classes is oftentimes during changing market conditions, various asset classes will move, or they're uncorrelated. They move in opposite directions, right? And a quick example of that is, recent history over the last 18 to 20 months. Federal Reserve Chairman has been raising interest rates pretty aggressively. And typically in a rising interest rate environment, commercial real estate doesn't do very well. But conversely, private credit, because most of it's floating rate, does do pretty well.
Yeah, exactly. I think it's an interesting combination looking at how private markets perform compared to public markets. And to your point exactly, if you want diversified asset class exposure, having access to private markets, we think is very important. 86% of companies making $250 million or more in revenue are actually private. You would think based off of news headlines and what we see, in the market and, as far as when we think about big companies, you think, the Microsofts, the Googles, the Nvidias of the world, but really so much of the US economy is private markets. And so having exposure there, we think is really important. And I think as far as when you're talking about those non-correlated assets, it's good to have that private market exposure as well, because when we go back to talking about looking at it through an advisor lens, you want to have that counterbalance to the portion of your portfolio that's moving up and down every single day, that being your private or your public equity, your public debt. While on the private side, those are only marking to market or changing in their value on your portfolio, call it once a month or once a quarter. So it creates this nice ballast for a broader investment portfolio that you hope is going to go up and to the right over a slow period of time, but it's going to make fewer ticks along the way. And so I think that's where it really plays into a great part of an investor's portfolio.
Yeah, and to your point about when they only mark to market quarterly or monthly or quarterly, there is an illiquidity premium associated with private assets. And so, if your money's going to be locked up for a little longer term, then you expect to, receive a premium over that time.
Exactly. And so I think it's important to bring up, why are we having this conversation right now? Maybe why, other than the podcast not existing a year ago, I think we're having this conversation with investors more and more frequently now. And I think a lot of that has to do with the structure of private investments, of alternative investments. Historically, it was not very palatable for many retail investors like ourselves, like our clients, to get into these private investments. One, because the private investment managers were not really looking to retail dollars for these investments, but they decided, hey, this is an untapped pool of wealth. There are individuals who desire accessing these investments, this area of the market, and we can provide some value here. So how do we access these dollars? Well, historically, the structure of these investments was very unpalatable for the investor, and probably anybody who has some private markets experience, more than say 3 years ago, probably experienced this, where you're talking about locking up your capital for 10 to 13 years, having capital calls you have to manage where, hey, the manager's saying, now we need 50,000, now we need 100,000 over a series of maybe 3 years to get actually invested. The tax treatment was not favorable with K-1, tax filings. And I just think that as far as when it comes to the investor experience, it's gotten much, much better today.
Yeah, for sure. These big PE sponsors, they saw how much money was gravitating to the RIA space in both family offices and in the high net worth retail investors. And they said, how can we make this more palatable, to your point, to these investors? And so they've come up with a structure where the retail investor gets to invest directly alongside the biggest institutions and endowments out there. Now they have what they call an evergreen structure. So the fund lives into perpetuity. All of your money goes in day one. You can get in monthly. They typically have quarterly liquidity after every fund's a little different, but 1 or maybe a 2-year lockup. And if it pays distributions, like in the private credit space, typically pays distributions either monthly or quarterly. And then the last piece is the taxation. Historically, they were all K-1 driven, which a lot of investors get a little irritated because the K-1s come out much later in the year. And most of these are 1099. So just an overall much more retail investor friendly in structure.
Yeah, definitely. And I think that part of being more approachable for the investor is really important here, because while there still are private investments that follow that old structure, the trend is definitely in this direction. And that's how you and I are able to better incorporate these into client portfolios.
Yeah, almost all of them, even if they came down to the retail investor, were qualified purchaser, where you had to have $5 million or more in investable assets, and more of them are becoming available to accredited investors. And so it's just becoming much more approachable in our space.
Yeah, and I think that gets us right into, who are private investments, alternative investments appropriate for. It's going to be a slightly higher wealth category as far as retail investor goes. So typically, like you just said, the threshold's accredited investor. Probably the easiest way to remember that is if someone has, $1 million of invested assets, then they're going to qualify for that. So that if they check that box, then number 2 is really just having a time horizon of a year plus. You don't really want to get into these, even though they have more liquidity now, you don't really want to get into these investments unless your investment horizons, over the 1 year mark. I'd say 3 years plus is probably what makes the most sense. But you shouldn't really be investing in broader markets in general if your investment horizon is less than a year. So having that kind of combination of a wealth level that makes sense so that you can be diversified across these investments, and then having an investment horizon where you can benefit from the long-term growth of these is important.
Absolutely. And because they're making it more approachable to retail investors, historically, if you go and you look at the big endowments or pension funds, their allocation to private markets is typically 40 to 45%. You come down to the big family offices, the ultra high net worth families, their exposure is typically about 25% to private markets. And you come all the way down to the individual normal retail investor, and they have less than 5% of their portfolio in the private market space. And now that the companies have built a structure where they're more palatable, more approachable, I think it's especially within our firm, we're making a real push to where it makes sense to increase the allocation size across the board.
Yeah, exactly. And I think now is kind of a good time to go through some of the asset classes within private markets. I mean, at the top of the podcast, we kind of mentioned it, but the 3 I'd say that we really focus on the most are private credit, private real estate, and private equity. Now, these 3 have grown into these funds, these evergreen structures that we're talking about, and we're looking for funds that are diversified in exposure so that we're not taking asset-specific risk, are palatable for the investor, and benefit from this, illiquidity premium, but also this private market just premium and exposure that we think is going to bode well for them over the long term.
Let's start with talking about the private credit market. From an advisor's perspective, I like to look at it and think about private credit as a replacement for fixed income or a bond portfolio. You look at the traditional 60-40 portfolio, and over the last 5 to 7 years, both the equity and bond markets have become more correlated than really ever before. And with the Federal Reserve holding interest rates essentially at 0, when you look at the investment grade corporate bond index, it's averaging about 4%. They're ranged between 3 and 5%. Well, after you pay ordinary income tax and a little bit of inflation, your real yield is pretty minimal. So we're seeing almost double those kinds of rates in the private credit market, and we feel like it's a great opportunity for our clients to double the yield and have a similar risk profile exposure.
Yeah, exactly. And I think if you're working with a quality manager, they're going to do good underwriting to make sure that those loans are very attractive because these companies are looking for easy access to capital. They're looking for a partner that's going to work with them through this experience of paying off this loan over time. And if you're a manager who's lending out this capital, you want to make sure to every extent possible that this company is going to pay back their debt. So doing that quality underwriting, making sure that this is a quality business with good cash flow, I think is really important when talking about the manager interacting with the company that they're lending to.
Yeah, and I think it's important to note that all these funds are a little bit different, but most of the ones that we're looking at are 90+% senior secured loans. So you're at the top of the capital stack. They're 100% floating rates. So as we've experienced rates rise over the last 18 months, the yield to the investor has gone up. Now, that being said, we expect interest rates to slowly come down over the next 18 to 24 months. So the exceptionally high yields that we're seeing right now in the private credit market will come down a little bit. And then the last thing that's important to note is most of these funds run a loan to value ratio at about between 30 and 40%. And that loan to value, we think about real estate as being, a pretty safe place to invest. But when you go buy a home, you put 20% down, well, you're getting 80% loan to value. So it's important to note that these loans have a considerable amount of collateral. The company has a considerable amount of collateral that if something does go wrong, they default, then there's assets there for the lender to fall back on.
Right. And I think that piece is important, that loan to value, and the fact that these are typically somewhat mature companies. They're not writing loans to very early stage non-cash flowing, non-profitable companies. These are companies that have already proven they should have the capability of paying these loans back. And, barring some unforeseen circumstances, will be able to. They just want to work with a manager who's going to help them build their business, grow with them, and ensure that they're able to pay this loan off because they are this growing company who has good, prospects for the future. And I think going back to what you said about the Federal Reserve and, short-term interest rates. So yeah, we're talking usually 4% to 6% above very short-term rates. Right now, the Fed funds rate, around that 5% level. So you're talking kind of 9 to 11% on these loans, which does seem high. But in order to work with a quality manager and have the flexibility of funding, this has been really important for these private companies. And then just looking at the broader macro picture, I mean, the big banks and even regional banks, because of the interest rate debacle that really hurt the balance sheets of a lot of banks back in 22, and with the, unforeseen and kind of, questionable regulatory environment surrounding them, they've really tightened back on lending. So when these private companies are thinking about, raising capital in debt markets, they don't necessarily have the option of going to a big bank and getting that financing. Now they're able to work with these private credit managers who are able to extend these loans and help them out, make sure they're able to pay it back along the way.
Yeah, and one other thing to note on that spread, and a lot of people ask, well, why is a company willing to pay such a much higher spread on the private side than maybe you would if you went in from a traditional bank? Well, you also get a little bit different partner whenever these big PE sponsors come in and write these loans, because they do become a strategic partner of your business. Typically in their lending fund, they have somewhere between 300 and 500 portfolio companies. So they get to see a wide range of businesses. In addition, they do a lot of cross-selling within their lending portfolio. So they help companies generate additional revenue. They help them identify talent. They help them with operational efficiencies. They help them with HR and healthcare costs. So they're really trying to promote them on the top and bottom line and make the companies as profitable as possible.
Definitely. And so I think we did a good job of covering private credit, attractive asset class. I think those floating rate loans are really nice for an investor who, especially someone who's looking for income, because those are distributing really well. And another asset class in the private markets that kind of goes a little bit hand in hand with that, slightly on the more conservative side, like credit, is private real estate. And I think we've seen that be attractive because if you're talking about what you want a real estate portfolio to do, it's not going to be your super growthy kind of investments. You want it to outpace inflation slightly, grow that income distribution, and just be an attractive kind of solid piece of your portfolio. Now, the problem with public real estate investing, which is commonly done through a REIT, which definitely have their place in portfolios and can provide value. The issue with those is what we're going back to is they mark to market daily and those prices are fluctuating every single day. So the secure, stable, safe part of your portfolio that you want in real estate is now fluctuating on a daily basis. Whereas on the private side, like we said, those are marking to market once a month. So that value is staying closer to what the actual value of that real estate is. I mean, when you think about your own home and its value, you're not thinking about, hey, it ticked up, $5 today or it's down 1% today and 2% tomorrow. I mean, you're thinking, hey, whenever I want to sell my house 5-10 years from now, it should be worth, X amount more. Well, we're thinking about the same thing when it comes to, these bigger, more commercial projects. And we like infrastructure, data centers, and some areas of housing we think are pretty attractive right now.
Yeah, and to piggyback on that, we started at the top of the podcast talking about asset allocation, and I made the point about rising interest rate environment over the last 18 months, not good for commercial real estate. Well, we've seen the end of the rate hike cycle. Federal Reserve has already made the first cut in rates, and we anticipate over the next 24 months that rates will continue to fall. Well, in our viewpoint, that's going to be a strong tailwind for commercial real estate, and we think it's a good time. We've seen kind of the bottom of commercial real estate about 6 months ago, and we think it's a good time, like you said, in the specific sectors that we like to get into the space now.
Yeah, and I think that it's interesting to track the difference in private market valuations versus public markets, because a lot of times it seems that the public markets tend to kind of lead private market valuations. Well, we've seen, like you said, real estate really bottom over the last 6, 8, 12 months. And now those valuations are starting to tick higher. Well, we think it's a good time to allocate to these private real estate markets because those valuations, now that they really have found a bottom, I mean, you're still talking about quality assets. We stay out of office space because of the whole debacle still coming out of COVID. But whenever you're talking about quality real estate assets, it's really that valuation that you're putting on it whenever you're getting it back into growth mode. And so we think there is a good flight path for that on a go-forward basis.
Yeah, and the one last point I'll make about real estate, again, is as rates started really, dramatically rising, especially when we're talking about the commercial real estate world, any projects that had started, they completed them. But in the last 12 to 14 months, there's been no new starts of big commercial projects because of the cost of capital. And so when you're looking at tailwinds for the sector, there's not going to be any new supply hitting the market. So what's out there is also going to appreciate in value, in addition to cap rates compressing and the natural appreciation of the asset. Absolutely.
Well, we covered private credit, we covered private real estate. Now I think our third asset class that we like, that's a little bit more on the growth side of the spectrum, just like your public stocks would be, is private equity. And so I think, we have had some experience with this. Like I said, I think that the structure has lent itself better for the end investor because now we're talking about diversified funds. But I'd love to dive in a little bit about private equity and kind of what we're looking at there.
Yeah, so you kicked it off earlier and mentioned how vast the private market, private equity space is, that 86% of the companies in the U.S. making $250 million or more are private. Until we started diving into private markets, I really didn't understand that the space was that large. And so if you're not participating in that segment, you're missing out on a huge opportunity in the market. And part of that is because companies are staying private for longer. I saw a stat the other day that said in the year 2000, the average company that IPO'd was 6 years old. Well, in 2022, the average company was 11 years old. And that's become a reality because the capital available in the private market space has grown significantly over the last 20 years. Back in 2000, if you were a company trying to get growth capital at somewhat of a cheap rate, your only option was to go public. And now that's not the case. And so you're seeing multi-billion, 30, 40, $50 billion dollar-companies that are still private in the private markets.
Yeah, and I think diving into what private equity really means, at least for us whenever we're investing in it, is you're not necessarily talking about what a lot of people think of as startups, venture capital. These are not very, very early stage companies that we're investing in. These are kind of mid-stage or late stage growth companies that, like you just said, are staying private longer because they have that opportunity to. They have access to private credit. They have access to private equity, which means they get to stay away from the IPO and public markets. And there's a lot of reasons to do that these days. I mean, one, with the media, your name can get out there a lot more without having to be a publicly traded company. And then two, you're not having to deal with quarterly reporting. So you're not having to go to investors every single quarter and say, hey, this is why you should still own my stock. Please buy me rather than sell me. You're typically invested alongside, your limited partners who are interested in seeing you grow over a longer period of time. And then three, the regulatory costs. Whenever you're SEC regulated, whenever you have all these regulatory authorities looking over you, it becomes very expensive. And all of these things kind of inhibit these private companies from being able to operate the way that they would like to, and really fundamentally from the way they would like to run their business. So it's becoming an attractive way to maintain your business is just stay private, because why would you go public given the current market circumstances?
Yeah, and to your point on not having to do quarterly reporting, another thing that comes along with that is all of your financials and everything about your company is not out there in the public. And you also don't have 50, or in big company cases, 125 analysts digging up your skirt every week, looking, calling, and putting it out there in the public. So because of that, a manager that takes the time to really get to know and understand a privately held company has the ability for extensive value creation, right? Not only do they have vast knowledge about businesses all across the spectrum, but when you really go in and you dive into an individual company, there's tons of opportunity for that manager to come in and make a real significant difference, as opposed to the public markets. Everyone knows everything that's going on with the company.
Yeah, absolutely. And I think that leads us in really nicely to what you and I do whenever it comes to manager selection, making sure we're investing in the right areas of private markets. Because to your point about the managers that these companies work with, so much of this is manager selection. If you're talking about an ETF provider or mutual fund provider, those returns on the public side are usually very tight between top and bottom quartile. But when you're talking about on the private side, who you're working with, who you're investing with really, really matters. I saw that as far as private equity goes, over the last 10 years, the average difference in annualized returns between top quartile private equity and bottom quartile is a 20% difference. In private credit, it's about 5.5%. In private real estate, it's 15.5% difference. And so you're talking about serious differences in returns depending on who your manager is. So that's part of our job, is really making sure that we're working with a partner who has oversight over these growth companies, over this debt and credit, or over this real estate, to make sure that our investors, our clients, are going to benefit.
Absolutely. I couldn't have said it better myself.
Well, now that we've covered those three, I think it's also important to kind of reiterate what our job is. As I said, manager selection is key, so us focusing on that is a big portion of it. And then I think it's also important to note that retail investors don't have access to private investments outside of an advisor. This is an area of the market that regulators still want to see that there's plenty of oversight being done, because a lot of these, private equity investments, or what we like to call club deals, where someone's trying to pitch you on a single asset, maybe, a storage property or some kind of venture growth company, may not be the safest thing for the investor. So it's our job to be that go-between and really help our clients determine what they should be invested in, how they should be invested. It goes back to the top of the conversation when you were saying, hey, asset class selection is also very important, and us helping our clients determine which asset classes within the private markets are really good for them.
Yeah, because none of these categories on a standalone basis are a one-size-fits-all, right? They're all intended to be complements to your existing publicly traded portfolio. And so that's where we really come in from the advisor perspective, is sit down with the clients, really understand what are your financial goals and objectives that you're trying to accomplish. Is that long-term appreciation, or these assets you're going to pass on to your loved ones and family members? Is this current income that you need to live on in retirement now? And a lot of times it's both of those things. And so we really sit down, understand what you need, and then pair and match your existing portfolio with some of these private market investments to complement what you're currently doing.
I think that was perfect. Justin, I know you do a great job with your clients when it comes to dissecting markets, determining that allocation. And so I want to thank you for coming on the podcast today, for sharing this conversation. I think it was a good one.
Thanks, Victor. Thanks for having me. I always enjoy talking about private markets.